and check out the orientation class today that I've just taken. So if you're planning to purchase our course, then it's high time you can join our batch. ABFM is started just from today itself. That means if you are planning, then you can enroll yourself and get enrolled and start studying regarding the ABFM right away with me. I'll be available. The class timing is at 8 a.m. in the morning. So be there. And everyone, chaliye, let's talk about the particular course that we are covering up. I've done the entire courses in detail with you already. So in this case, I'm covering up chapter wise, a little mix of these things I've also already taken. So this is basically the area that I'm talking about today is hybrid finance. Acha, everyone, what do you mean by hybrid? I think hybrid can be something which I can say hybrid can be stated as something where okay, I found a good variety of seeds, that is X. There's another good variety of seeds, Y. But this variety of seeds has a few different advantages, and this one of course has different set of advantages. But they have their own limitations as well. I want to create something which has a few characteristics of X and a few characteristics of Y. So what will I do? Simple. I will turn up and make up a new specific product which has both of them, but as per my customization. In terms of finances, even you have one type of securities, that is one, the second types of financial instruments, that is two, and then you decide ki nahi, I want to have the mix of both of them. You want the best of both worlds. So if you're trying to do that particular part, then that's it. Have a hybrid. Those hybrid can include preference shares, then these can also include warrants, these can include various other securities, right? So these are the different areas where you can put money and you can ensure better returns, plus if you're looking forward towards ownership, you can also get it. So these are hybrid finance. So this is what we have talked. I think we were talking about it in the last class as well. So today we are covering it up further. Done, everyone? If you like this session, please go ahead and click on the like button, everyone, and share it among your peers. That is super duper important. And if you haven't subscribed to our channel yet, then hurry up. The time is ticking away. Okay, what's going to be the answer, everyone? What happens to the right to receive dividends in arrears for non-cumulative preference shares? Acha, what happens is sometimes the organization is having inadequate profits or they have losses. During this period, obviously, they cannot pay. When they cannot pay, then what to do? When they cannot pay, what they need to do is, first is what happens to the right to receive. See, cumulative means it gets accumulated if we are not able to pay. Non-cumulative is a scenario where we cannot accumulate it at all. It is forfeited if the dividend is not declared throughout the year. It accumulates until fully paid. It remains unaffected regardless the dividend declarations, or it is automatically paid out of the end of the year. See, we have cumulative, we have non-cumulative. Cumulative is the one where if we are not able to pay in 1 year, we'll pay in the next year, na? And together. Sorry. I'm sorry. Then, in this case, the next part they say is cumulative preference shares are the ones in which we are collecting the dividend together. In this case, we do not collect the dividend together. If we cannot pay, then cool. The next year when we'll be making the payment, we'll make the payment only for the next year, not for this year. So in this case, the answer is going to be it is forfeited if the dividend is not declared throughout the year. It becomes due only if we have money and if we can pay. Now it is not even declared. If we cannot pay, then there is no point that we will be thinking about it. Done, everyone? What additional rights do participants prefer? Participating preference shares grant to the shareholders. Right to receive dividends in arrears, right to participate in the surplus profits after equity shareholders are paid, and then we have right to convert into equity shares, and the last one is right to vote for company resolutions. What additional rights do participating shares have? See, there are 2 points. One is participating preference shares, one is non-participating. Participants have a situation where if the company has a surplus, taken if the company is having a surplus, then they will share the surplus with only equity. Normally it is only for equity, but in a certain case, it can be shared by the people who are preference shares as well. First of all, when the surplus is received, preference will get their chunk and the remaining is extra. So then equity will get their chunk and this extra will always be in the hands of equity. Okay, sir, we have got surplus. Other than your dividend, we are giving you more because we made a lot of money. So we all will be paying this off. ठीक है ना? Now comes the next part. Preference shareholders felt that array even I need the money. This surplus should be mine as well. So we can also give them this amount. But how do we pay them? Simple. When we have to pay it to them, the basic way of the payment is we have equity, we'll give it to the preference and this surplus will be shared between equity and preference shares again. So preference will get a chunk of this surplus again and the remaining is all of equity. So this is where these people have a chance. That means the surplus or participating part will still be theirs. That is, they don't have the right to convert into equity. They don't have the right to vote. They get the vote only when the company defaults. They have the right to receive dividend in arrears. No, that is cumulative. In this case, the answer would be B. What is distinguishing feature of non-participating preference shares? Participating and non-participating, there are two different areas. They grant the holders the right to participate in surplus or they have a predetermined rate of dividend. Actually, non-participating says, see, this is the major chunk of profit that we make. Out of this major chunk, preference shares get your money and that's it. Equity, you're getting your dividend and then extra money is also yours. Done. So they grant the holders the right to participate in surplus profits. They receive a predetermined rate of dividend without additional rights. They can be converted into equity shares or they accumulate unpaid dividends. The answer is B. Done, everyone? Next question. Subscribe to our channel, everyone. If you haven't subscribed it yet, you should definitely get going because there are so many things that we are coming up every single day. So if you're coming up with so many things, you should definitely check out our courses, right? So just plan it up, and if you're planning, then hurry up, get enrolled in our courses right away because all these things are updated for you every single day, right? So just check it out on our website and our app for further details. Acha, at the same time, if you're downloading, then if you're subscribing to our channel, you should always go through our app as well. There's a lot of free content available along with this, not only the free content, but also you get the opportunity to purchase our courses at 1% additional discount. So that is available or accumulated for you in the form of coins. So if you are looking forward to it, then hurry up and enroll yourself right away. Acha everyone, next pointer. What distinguishes the redeemable preference shares from non-redeemable preference shares? Acha, what do you mean by redeemable and non-redeemable? Everyone, what do you mean by redeemable and non-redeemable? Redemption means payment. Redeemable preference shares are those preference shares that redeemable means the payment. In our country, preference shares can only be of one type. Overall, it is of two types. Preference shares can be of redeemable nature, matlab we have to pay for it, or it can be irredeemable. So when we talk about redeemable and irredeemable, what is the difference? Redeemable means the ones in which we can make the payment at after a certain period of time. Irredeemable means when we cannot make the payment throughout the life of that asset. That's a specific rule, everyone. Okay, that means the payment has to be made. If I'm talking about the payment to be made, then that is during the lifetime of the business. For example, in equity, we specify if you have invested, then till the time the business is there, you are not gonna repay. Right? Equity doesn't get the money till the time the organization is not dying or it is not dead yet. That's one particular thing that I'm absolutely clear about. Preference shareholders, on the other hand, these people have a problem. Preference shareholders, they would be getting the payment only and only after a certain period of time, which is already predetermined. In equity, there is no predetermined area. Otherwise, if we talk about redeemable, they define in our country irredeemable. The situation where there is no payment defined. The time tenure is not defined. This is not there. In our country, we normally have to repay preference shares within 20 years, or if we talk about the other ones, we are looking forward towards, second point would be, infrastructure companies have a time period of maximum 30 years. They have a little more. So redeemable preference shares have a maturity date for redemption. Yes, they have. Non-redeemable accumulate unpaid dividends. No. It just says only one particular thing that we have to pay. That's it. Irredeemable means we don't have to pay. है ना? One is we have to pay, one we don't have to pay. Then redeemable preference shares can be converted into equity. They are convertible and non-convertible, everyone. Then non-redeemable preference shares grant voting rights to shareholders. No, they don't. So in this case, what's going to be the answer? That is, redeemable preference shares have a maturity date, maximum 20 years. Next question. What is one of the reasons for issuing preference shares, everyone? One of the reasons to issue preference shares. I think my major reason would be I don't want someone to have voting rights. But because they are better in terms of this. To offer high returns in primary market, to attract investors with tax advantages, to provide flexibility in repayment, or to avoid the need for mortgage or hypothecation. Done? When we talk about what is that one of the reasons for issuing the preference shares, I think when I'm looking forward to one of the reasons, it provides high returns. No, they don't. Primary market, there's nothing of that sort. It attracts investors to take tax advantages. No. Actually, in terms of equity and preference, one of the hardcore fact is that they do not get the claim of dividends. Then comes to provide flexibility in repayment. You can say, but then this is regarding dividend only. Now you have to pay, otherwise this will impact your reputation that you cannot pay off. And then is to avoid the need for mortgage or hypothecation. So I think I'll go for mortgage or hypothecation. You don't have to take a loan. This is actually owner's funds and he decides what he wants to do about it. Done? How does the taxation of preference dividend affect investors' interest? Taxation of preference dividends. Actually, preference dividend is not allowed as an expense. That's one of the worst part about it. That equity and preference, whatever they are getting, ultimately companies keeping their investors happy, but still, you don't really have that benefit. है ना? So in this case, one of the things is investors are exempt from taxation on preference dividend. No. Actually, yes, only when, yes, this is allowed, but for that, the company has to pay dividend distribution tax. The taxation laws do not affect investors' interest. No, no, definitely it does. Basically, the dividend was for a good amount of time, dividend was completely exempt. Recently, it has been reduced to 5 years, to 5,000 rupees, above 5,000 is taxable. Earlier, it was totally exempt. Then taxation impact investors' willingness to accept lower. No, people can definitely invest in equity if they want more returns. That's not the point. Taxation have no influence. They have an influence. That is why people used to look forward to it. Taxation laws impact investors' willingness. No. The correct answer, how does the taxation of preference dividend affect investors' interest? The answer is investors are exempt from taxation on preference dividend. That is exempt. That would be one of the basic reasons that people look forward to it. So answer is A, not C. What is redemption date of preference shares? The date on which we are making the... What do you mean by this, everyone? The date of issue of preference shares, the date when preference shareholders receive dividends, the date on which the debt repayment is planned to take place, and the last one was the date when preference shares are converted into equity. That is convertible. That if you look forward to the answer, that on which the repayment is made. That is basically the area we're talking about, this specific thing only. And I'm with you with the area of ABFM, Advanced Business and Financial Management. I hope I'm clearly audible, everyone. And we all are doing well in terms of our examination. Everyone, the examination registration dates would be announced soon. I think that would be starting from the first week of May itself. So you have enough time to decide what you want to do. Hardly a few days are left. So if you're planning for your examination, then what is exactly your plan of action? And if you're planning, then hurry up, because you should get yourself registered in our courses. You should definitely go ahead and start your preparation right away. I have recently started with my batch for ABFM. So if you're planning for ABFM, BFM and all the other subjects, then kindly go ahead and check out our courses right away, because it is super important at this point of time to start your preparation. Then everyone, chaliye, let's move on and talk about what are we studying. I was working upon the specific topic of hybrid finance. Hybrid means two specific types to be considered as one. Uh, Actually, you have got one extreme and the other extreme end in terms of financial strategies, and you pick up both of them in terms of the best of them. So in this case, that is called hybrid finance. Acha, everyone, here comes the first question. What do you mean by the term warrants? I think today we have more of the questions which are somewhat, I can say the questions that we're going to deal with today is more or less short questions which will really help you to understand the minute terms. What are warrants, everyone? What's going to be the answer? Warrants are basically the rights to receive the shares. It's like a right that you can have the share in future. Warrants are basically rights to receive the shares in future. We currently don't have the shares, but yeah, we can have the shares in future. That is what we find in this area. So in this case, obligation to purchase equity shares, right to purchase equity shares, right to sell equity, or obligation to sell equity shares. What's going to be the answer according to you? What's going to be the answer? I think warrants are basically right to purchase equity shares in the future. You don't have the share right now, but yeah, you have that specific option in the upcoming future that you can have the shares. So this answer would be right to purchase the equity shares. Obligation means this is something that you have to do. Right to sell or obligation to sell. It is actually a right, not an obligation. You haven't done something for the organization where you are being obligated about it. है ना? Now, what is the upfront payment for the buyers in terms of warrants in India? 50%, 25%, 75 or 100? What's going to be the answer? If I look at the answer, the answer has to be 25%. Okay? The answer is 25%. According to SEBI guidelines, what must be determined and reported in the prospectus of a convertible debenture? Achha, what do you mean by convertible debenture, everyone? convertible. Convertible means which can be converted into something else, you know, and they are talking about debentures. What's going to be the answer in this case? Convertible debentures can be those kind of debentures which were basically loans, that is, debentures a debt instrument. If we talk about this debt instrument converted into equity is called convertible. Because if it is converted into any other form, it's not beneficial. If you're an outsider, you want to become an insider for the organization, isn't it? You don't want to remain the same person anymore. What's it? Done. Chaliye. Now let's move on to the next point. That is, it is a conversion of premium in timing of conversion. Okay, so they are basically reported at what point of time? At the time of conversion price, at the time of premium, at the time of conversion, and the premium conversion duration only. It is basically C, conversion, premium, and timing of conversion. Okay. If you haven't subscribed to our channel yet, then hurry up and subscribe our channel right away. Our courses are there, everyone, on the portal as well as on our website and app. Everywhere it is like that. Acha. Now, everyone, next question. Next question says, when does the holder of convertible debentures have the option to convert? When can you do that? At or after 12 months or before 12 months, 18 to 36 months, 24 to 48, or that is 36 to 60. In this case, the correct answer is at or after 18 months but before 36 months. They have a time tenure na. वैसे तो every organization will have their time tenure through which you can do this, because even the conversions are not compulsory. You know, conversions are at the option of the lender. They will put up that particular option, and once that option is put up, then the receiver will be basically ask you, when do you really want it, कि you want to have the money after a certain period of time, है ना? चलिए, next point. Which factors affect the gap between the current market price of the warrant and its minimum acceptable level? Market demand and supply, it really affects it. What do you think? It does. Then issuers financial health. What's gonna be the answer? Economic indicators or fluctuations in stock prices. Or fluctuation in stock prices remaining, and Remaining time before expiration, risk-free interest rate, or value of the stock and exercise price. What's gonna be the answer? When we talk about the gap between the current market price of the warrant and the minimum acceptable level, na, we're looking at two things together. Current market price is the prevailing price, while when we talk about minimum acceptable level, what is it the particular person is thinking about? Market demand and supply obviously affects it. Issuer's financial health, we can say that, because ultimately the company issuing the particular shares really matters, na? What is its price in the share market right now? Economic indicators, they're not really the ones. I think I would wait for fluctuations of stock prices, remaining time, risk free. All these points definitely affect it. So I'll go with D there. Next point, which statement is true regarding the expiry time of convertible compared to the warrants? Everyone, what's going to be the answer? Convertibles have shorter expiry period. Convertible and warrants have the same expiry period. Convertibles have more time until they expire, or warrants have more time until they expire. I think I'll go with the convertibles have often more time. Because convertibles normally have more time than warrants. Warrants are basically rights that you can receive the shares in future. While if I talk about convertibles, convertible is what? Convertible means you are not compulsorily required, but yes, you can convert your share, your debenture into a share, right? That's the next point. So convertibles often have more time until they expire. Acha, how does the valuation of optionally convertible debentures compare to compulsorily convertible debentures? Optionally means you have a choice that you want to or you don't want to. Compulsorily means these are somewhat, if you have bought these, it is assumed that yes, you want to have that. You know? So optionally convertible are valued lower or they are valued higher. Then valuation of optionally convertible is similar, or there is no valuation difference between the two. I think I won't say it is absolutely same, because obviously there's a difference. It is at the choice of the shareholder. If the things are at the choice of the shareholder, then there is only one point which is absolutely clear. That is C point. Valuation of optionally convertible debentures is similar to that of compulsorily convertible debentures. That's one part which they're absolutely clear about. Okay, so this is C. How is the conversion ratio defined in the context of convertible debentures? Price per share paid upon conversion, the number of debentures exchanged for one equity share upon conversion, or the interest rate paid on the debentures or maturity period of the debentures. How is the conversion ratio defined? For how many debentures we'll be converting it into shares, है ना? We have to look at that ratio as well, na? What's going to be the answer, everyone? This ratio is clearly defined as, see, if a share, there's a difference between the price of a share and the price of a debenture. The debentures are normally priced, face value is normally at 100, while shareholders are normally priced at face value rupees 10. In the theoretical way, at least, because in the practical world, it keeps on changing. So this is price per share upon the conversion. No, it's not about the price. It is the number of debentures exchanged for one equity share upon conversion. That means how many shares you will get by giving your debentures away. Interest paid or the maturity period. In this case, the answer is B. The number of debentures exchanged for one equity share upon conversion. How does the Companies Act 2013 prevent reduction in the shareholders' funds during the redemption of preference shares? By distributing profits to shareholders, by issuing fresh shares, by transferring the profits to the CRR, or by reducing the nominal. We have shares. So psychologically, the lenders know that these people are the people who have invested their funds into the business. The moment preference shareholders are leaving, we are to be the lenders, the particular people who of the organization is declining. I don't know what's gonna happen next. So obviously psychologically, na, there's a fear. So how do they deal with it? They say कि कोई बात नहीं, even if people are leaving now, then by transferring the profits to the CR, by transferring the profits to CRR account. What is the purpose of REIT is there, and psychologically the lenders are not scared anymore. To increase the financial, so what to do about it? है ना? To reduce the liability of the preference shareholders, nahi. Preference shareholder liability can be reduced only when these people are leaving the organization. Otherwise, we are supposed to pay them to maintain the same amount of shareholders. In actual, we are just making sure that in this case, one thing that happens is we have to maintain the same amount. The amount should not be lessened. If they were in the form of shareholders, it's good. If they're not in the form of shareholders, then we cannot. Let's keep them in the form of reserves. The total amount should be the same, like share capital, then reserves and surplus. Then you have your then this share capital has equity as well as preference. If preference is gone and you add the same amount here, the total remains the same. If the total is same, everybody in that particular scenario is at least in a better situation. That is what I think. That at least they're in a better situation to maintain the same amount of the shareholder funds. Done. How does redemption through fresh issue directly safeguard shareholder funds? By increasing the nominal value, by reducing the number of outstanding shares, by maintaining the same amount, or by distributing additional profits. If I talk about how does redemption through fresh issue is basically issuing more shares. That means you're getting more money. When you're getting more money, in this case, one thing is happening. You have to maintain the particular level. If redemption is done, so you will also get the same amount of shares for the company. What is the maximum risk of risk-weighted assets in that perpetual non-cumulative preference shares PCNPS in additional tier 1 capital cannot exceed 1%, 1.5, 2 or 2.5? The answer is 1.5%. Then everyone, the answer is 1.5%. What would be the answer to this question, everyone? What does the process of deal structuring and acquisition involve primarily? Firstly, what does it include? Is it the determining the target liabilities or allocating risks and achieving major objectives or finalizing the payment method or obtaining financial options? What's the first and the foremost thing that they have to see? When we talk about what is the process of deal structuring in acquisitions. Acquisition means purchase. We are acquiring the other organization. If we are acquiring the other organization, then one of the major things is, the first thing is always looking at the objectives, na everyone. So this is related to the area of allocating the risks and achieving major objectives. So in this case, the first and the foremost thing is always allocating of the risks and achieving the major objectives. What is risk sharing in context with deal structuring? Risk is something that the more you distribute, the lesser it becomes. This is one of the realities of risk. Sharing profits equally between the acquirer and the target, distributing the liabilities of the target organization to the acquiring company, allocating risk between the parties involved, or splitting ownership rights and responsibilities. What do you mean by the term risk sharing? Of course, risk sharing plays a very important role in every organization. See, because till the time you're not sharing the risk among different people. For example, banks do this part, refinancing, syndicate loans, all those things happen because banks know that sometimes it's not possible or worth it to take all the risks on their own. You know? So in this case, this is based upon allocating the risk between the parties involved. Okay? Because we are spreading up the risk among different people. This is spreading up of risk. In the context of accusation, what is the overall consideration method? Payment, approval, risk, allocation. In context of accusation means acquiring again. What is the process? What is the overall consideration method? How do we pay everyone? Payment method, consideration, or approval, risk allocation, or financing? It is the payment method. Consideration means what? What are we going to pay for that particular company that we are trying to buy? Right? Next point. Why is the corporate structure frequently utilized as the acquisition vehicle? Limited liability and flexibility in financing, tax-free deal options only, continuity of ownership only, or taxation benefits only? Corporate structure frequently utilized as the acquisition vehicle. Corporate structure is basically the organization structure which we are talking about, and once we change the restructuring and other things, then obviously this is something which changes, है ना? So why is this particular thing done when we're talking about acquisition vehicle? In terms of acquisition vehicle, the correct answer here would be limited liability and flexibility in financing. That's the answer. What is the primary consideration for using cash in the form of payment acquisition, everyone? What is the primary consideration for using the cash as a form of payment and acquisition? In terms of this, is it borrowing capacity of the target company, high credit rating of the acquirer, desire to preserve control after the acquisition, or size of the acquirer's cash balances? What's going to be the answer? See, the point is, what is the primary consideration in terms of cash payment? Whenever we are making the payments, what is that particular thing? Ultimately, when we are making the consideration payment, it is always a desire to preserve control after the acquisition. After you purchase the other organization, you really want to still maintain your control in the other organization, because ultimately the day you lose control, the organization's hold that you have or you possess is gone. Why do the acquirers with large cash holdings tend to make stock offers rather than cash offers? Target preference for acquirer stock, desire for tax benefits, preservation of control, or low credit rating of the acquirer. If you have low credit rating, then obviously the chances are less that someone else will basically take your money or involve with your company. So technically this is something I'm ruling out altogether. Why do acquirers with large cash holdings tend to make stock offers rather than the cash offers? Desire for tax benefits? Not really. So this is a part of it, because when you are giving shares instead of shares, in terms of amalgamation, yes, there is no taxation. Preservation of control, it doesn't really matter, because if you're giving shares to someone, then your control is gone. So eliminating this part as well. Target preference of the acquirer stock. So that means I had an eye on the shares, and I'm like, okay, if I'm getting a chance, I will buy your shares. That's the point. Target preference for acquirer's stock, everyone. Acha, next question. What might lead an acquirer to choose cash in the primary form of payment in acquisition? Why would someone take cash? Technically, when you are, so this is acquiring, but in terms of amalgamation, we have a different scenario. In terms of amalgamation, what happens is, even if you paid a single penny of cash, the entire transaction becomes taxable. If you do not pay in terms of shares, you give it in the form of cash or any other kind, then it is taxable. But if instead of shares of one company, you get shares of another company, then there is no problem. Since there is just a movement of shares, then there is a point where there is no capital gains on it. Matlab, because obviously you still have asset of one company to asset of another company. There is no difference coming up now. There is no overvaluation of target shares. Acha nahi. Well, this is what I'll talk about, the era of capital gains. Okay. So that is capital gains. In terms of acquisition, it is definitely different. The one which is selling is subjected to tax, but the one who's buying is not subject to any tax till the time he's not selling it. Done? Okay. Then overvaluation of the target shares or low credit rating of the acquirer. Then is fear of undervalued shares or desire for tax-free transactions. What's going to be the answer? What might lead an acquirer to choose cash? If someone is choosing cash, then probably because they choose as the primary. Overvaluation of target shares is not the answer. Acquirer means the one who's purchasing, है ना? The one who's purchasing, for them shares is a different scenario. Low credit rating of the acquirer. If they have a low credit rating, then they cannot look forward towards that. Fear of undervalued share. This can be a point. Obviously, if you think that the shares might not be at its true value, then it can be a different scenario. And then is desire for tax-free transactions. I think in this case, the answer has to be D only. You have a desire for tax-free transactions. You sometimes just play with the cash, and you sometimes don't even show that there's a movement of cash. Next question. Why might acquirer stock be used as a principal form of payment in acquisition with a long integration period? If you're looking forward towards long integration period, desire for tax-free transactions, potential reduction in existing shareholder base or reduction in total debt needed for the takeover, or fear of undervalued shares. Long integration period. Why would someone actually take a long integration period? Actually, na, when you want a long integration period, probably you have some liabilities which you want to take care of. You know, that can be the point, won't it be? So in this case, reduction in the total debt needed for the takeover. You really want that, because tax-free transactions is not the point where you're looking forward to long integration period. No, potential reduction in existing shareholder base. Nay, this is actually share reduction, but this is not the point. Fear of undervaluation is also not there. In this case, it's all about you just want to reduce your total debt before needed for the takeover. Because if you want to take over, or anybody else is trying to take over, always remember, if the liabilities are too much, then what will you do? We'll be stuck with that thought. Ki, Arey, the liabilities are already too much. How will we cater the entire work? Right? Genuine problem. I'm sorry. So let's move on to what's the next question now. Oh, this is actually in a mixed. The term is in. In a mixed or payment offer, why might the target company prefer the combination of cash and acquirer stock? What would be the reason? Why would someone look forward to what's mixed? But when we are looking forward towards the cash now, obviously, if we buy, if we are just getting the shares of that in terms of while making the payment, that the problem would arise, because in this case, the major problem that would occur is that in this case, you want to have tax-free transactions, no need for cash. Basically, the tax-free transactions aren't there at all. There is no undervaluation or overvaluation. In this case, you need money so that you can actually, first is you have the particular organization. Second is, in this organization, it has become specific working there. What we would definitely want is that when we have to pay for the shares, we can pay from the money itself rather than selling a share to arrange the funds now for the particular transaction. It is better that in this case, need for cash to pay taxes on the sale of shares. That would be the answer. How does a multiple option bidding strategy generate uncertainty? What would be the answer to this question, everyone? By predicting the total amount of cash required, by predicting the number of shareholders choosing each option, by incorporating a proration clause, or by reducing the overvaluation of acquirer shares. How does the multiple option bidding strategy generate uncertainty? Basically, it is generating too much of uncertainty, because in this case we are determining the number of shareholders choosing each option. Okay, this makes the entire thing very uncertain in nature. What provision in the merger agreements and tender offers help acquirers determine the total amount of cash they would be required to pay out, everyone? Overvaluation clause, proration clause, dilution clause, or convertible securities clause? Which specific clause? That is proration clause. Overvaluation is the valuing it at more than the share price. Dilution means giving up on that particular portion of your the core. We are actually giving up the shares to someone else. And convertible securities, matlab, the shares can be converted into debentures. Sorry, debentures can be converted into shares, because every time an organization will always try to convert their loans into shares. That is proration clause. Why might bidders hesitate to use stock over offer convertible debt as a form of payment? To avoid proration of shares, to reduce the overvaluation of acquirer shares, to facilitate tax-free transactions, or to indicate their belief in the nature of the target company. We are always doing this scenario so that we can actually reduce the overvaluation of the acquirer shares. Because if there is an overvaluation, the chances are high that later on the organization might be facing backlash from the market itself, right? Okay, so in this case, what's going to be the answer? The answer will be B. Done. Chaliye. Then let's move on towards the next topic. When is a transaction considered taxable to the shareholders of the target company?
everyone? What's going to be the answer? When it involves a majority of the consideration in the form of equity, and it involves a majority of consideration in the form of cash, debt, or something other than equity, when it involves a majority of consideration in the form of convertible securities, or when it involves a majority of consideration in the form of stock. The answer is when there is a mix of all these things, cash, debt, and something other than equity.
And I'm with you with the specific area of ABFM, Advanced Business and Financial Management. Everybody, I hope I'm clearly audible as well as clearly this PPT is visible to you. What are we talking about today, everyone? The basic topic that we have taken up is hybrid. What do you mean by hybrid, everyone? Do you know what do you mean by hybrid finance? Hybrid was basically the advanced level of finances which have been formed. This is not the basic level. This is advanced level because ultimately equity and debt were primitive. है ना? Two extreme corners. People wanted to have some, what do we say? Customized finances. I would say that I want this part, this feature, that feature I don't want. For example, some people just want to put money into something which is growing, but they don't want the ownership. They don't want the risk. Someone said, I want to have the right to buy later on. Not today, huh? No, but tomorrow I want to buy. That particular thing is covered in this specific area altogether. So when we talk about the hybrid finance, these are bigger terms, right? Based upon this, here comes the one of the hybrid finances that is called foreign currency convertible bond. What is the primary feature of it, everyone? First of all, go ahead and answer. I'll tell you the answer of this as well. Chali, let me give you the answer to this. When we talk about foreign currency convertible bonds, it's a basic term. Foreign currency. That means this is not in rupees. है ना? This is in dollars or yen or any other specific currency altogether, isn't it? Then comes issue, issued by issuers, domestic currency, issued in foreign currency, issued in fixed rate or variable interest rate. Foreign currency convertible bonds are those bonds which are issued in, I'm sorry, these are issued in foreign currency, and these bonds are convertible into equity at one point of time. So when we try to talk about these things, these are related to the specific area of accounting where we say that these are issued in foreign currency. Convertible means the bonds which can be converted into different securities altogether. That are called convertible bonds. And what is a bond, everyone? Bond means a debt. है ना? Done, everyone? Okay, next question. What the option does a FCCB holder have besides receiving regular coupon payments? Coupon means interest rate, है ना? If I talk about coupon, coupon is interest rate. What option does the FCCB holder have besides regular coupon payments, regular interest payments? What is it that they have? Multiple things. Options to redeem the bond only, options to convert the bond into equity. It says foreign currency convertible bond. That means it's a bond. Bond means a debt. Debt means I've given money to someone. If I give money to someone, then that simply means I'll be getting interest on it. I am entitled to it, isn't it? I have a proper right to receive money in future from the person. Then option to change the bond's interest rate. No, for foreign currency convertible bond doesn't say that you can change the interest rate of it for sure. Right? So what's going to be the answer? What's going to be the answer, everyone? Foreign currency convertible bonds. First of all, it is not an Indian currency. Number two, it's a bond with interest rate. Number three would be the point where it says that when we talk about the specific area, then it is related to the area of conversion of the bonds into something else. And that something is equity. See, if I am an outsider, the max I would like to become is an insider for this organization. Insider means I would like to become an owner in the organization. Why equity? Why not preference shares? Preference shareholders are those kids which are more or less living outside their houses. Matlab, they don't really have a say in the house every now and then. But equity shareholders have a very strong say. They are the risk takers. They are the one who are deciding what to do, how to do. They're the risk takers. They are the one who get the dividend. They have every single right over the organization which nobody ever will have. That's the strength of this particular organization's equity shareholder. They have voting powers. They get the residual money. They get to have the risk. They get to decide the particular path of the organization even. They're so strong, right? If you're a majority, then you don't have a problem in it as well. So when we talk about the bond now, you were an outsider. You become an insider. That's one of the strongest things that can happen. Got the idea? So that's the point. Why do FCCB typically have lower coupon payments compared to traditional bonds? Lower coupon payments compared to traditional bonds. When we talk about this specific area, foreign currency convertible bonds have lesser interest rates. But the point is, it doesn't matter. But that maybe if I can get an equity share of the company, I think that's the best thing to do, isn't it? Due to higher interest rate, due to lower demand, due to attractiveness of the conversion option, or due to government regulations. The point is that due to attractiveness of the conversion option, I told you in the beginning only, the one of the major points is, oh wow, that's the first part, that is foreign currency. Okay, I can get the share of the company, and if the dollar goes up, euro goes up, yen goes up, any of these particular currencies in which we're dealing with goes up, then I think I'm gonna make good money. Secondly, you have the option to convert into equity, another stronger part that nobody can beat up. You know? Everyone, subscribe to the channel right away because this is very, very important. As CIB is approaching, we are coming up with more and more sessions, more and more batches. Currently, our English medium batch of ABFM has started. I think it's been just 2-3 days, so you haven't missed much. I started it on Saturday only. Orientation class has been done and 2 of the basic classes regarding the basics of management are done. So I think if you look forward to it, you're good to go, isn't it? So if you're planning, then please do not get this opportunity to lose, because ultimately if you have time, you find our content useful, then go ahead and go check it out on our website or in our app for further details as well. One more important thing, that is when we talk about this specific area altogether, our when we talk about our specific area altogether, the entire information of our courses and the PDFs of our classes will now be available to you in our app only. So if you're planning, then check it out on our app right away. Okay, next question. It says, why is mezzanine financing considered expensive? Debt or cheaper equity? Mezzanine financing. Mezzanine is basically a kind of, again, a hybrid. That's again a hybrid. When we talk about mezzanine financing, and a mezzanine, I've taken a loan from you. Simple. I had a simple loan from you. I took that specific loan, and once I've taken that loan from you, till the time I'm making the payment, there won't be an issue. The issue arises when there is a default in payments. The moment there is a default in payments, that equity will be activated. That means this loan will now become like, I don't want the remaining amount. You convert it into equity. Give me a share of this organization. That means now I no longer want to have interest. Now I want to have a chunk of profits. That is mezzanine financing. Matlab, mezzanine is a mixture of equity and debt again. But at the cost of company. If they are making a mistake only, then they have to pay. Otherwise, they don't. Otherwise, they have to just pay the loan and that's it. Otherwise, they will have to give them equity shares, which costs more than debt. Simple reason is, in terms of debt, you are giving money to outsiders. Those outsiders are never going to enter your organization. They don't have a say. Until unless the loan is of a huge amount, a nominee director will definitely sit. That's a true part. But the fact is, if you talk about equity, equity shareholder has a saying in every single thing that is happening in the organization. And if they are a significant shareholder, if they are associate, that means they have more than 20%, then you're doomed. Everything that you are doing, you have to ask them. So you lose your freedom of operating in the organization. So it offers lower returns to the investors. It involves secured debt. Its cost is lower than the cost of equity capital for the issuing company, or it provides fixed interest rates. The answer is they have a floor and a cap of floating rates. No, the answer is wrong. The answer is something else. Mezzanine financing has, it is a lower than cost of equity. I think I'll go for this. This is a better one. मतलब mezzanine financing is better than going for pure debt or pure equity. You ask those people, if I won't be able to pay you now, only then and only then the situation will vary. Otherwise, we don't have to do anything like that. It depends upon me. If I pay properly, then why would you push me to give you more of those bonds and all? है ना? अच्छा, what is the characteristics of collared floating rate notes? They have a fixed interest rate, they have a floor and cap on the floating rates. This was the answer that got mixed there. They are denominated in a fixed currency, or they have no limitations on interest rate fluctuations. What is the characteristics of collared floating rate notes? When you talk about the floating rate notes, that means it has a floating cap. Okay, मतलब it has a minimum floor rate and then cap on floating. If there's a float going on, fluctuations going on, then there's a cap. After this, it should not happen. That is covered there. Somehow, na, the questions got a little haywire. Only a few questions had this problem. Next question. This is all corrected. What economic event prompted the issuance of collared FRNs by Salomon Brothers for the Leeds Permanent Building Society? This can be an option in terms of the examination, but for this they have to give more information. This is from the example of the book only. Severing the ties between United Kingdom and European exchange rate mechanisms, increase in London interbank offered rate, steepening of the yield curve in the United States, or decrease in the Bank of England base rate. What's going to be the answer in this case? Actually, the basic reason that they started looking forward to FRNs was the decrease in the Bank of England base rate. What they were providing, that had gone down a lot. So it was better to invest in these kind of things. Again, if you find more interest rates or returns in other areas, then I think we all go for the different securities. The securities which are providing better returns are always better. That's an ideology of every finance person, isn't it? Next point. What criticism do hybrids face according to the critics? Acha, hybrids face, they are too complex for investors to understand. Sometimes they are. They are driven by supply rather than market demand. They offer no benefits compared to traditional securities, or they are non only beneficial to investment bankers. Hybrids have 2 points. मतलब they are good even, right? Because they become the reason that the organization is growing for so much. But what is the problem that they face? I think if I'm trying to point that particular part out, the problem is that it is driven by the market. It is too much of unstable area. So that's one of the basic reasons. Done. What is the primary right granted by a warrant? Everyone? What is the primary right? Warrants are basically something which we say, sir, I cannot give you the share today, but yeah, I'll be giving you the share tomorrow. Right to sell a predetermined number of equity shares, right to purchase a predetermined, or right to convert debt debentures into equity or receive fixed interest rate. You don't have a specific equity share right now, but yes, tomorrow we'll be giving one. Right to purchase a predetermined number of equity shares at a predetermined price. Done. Chaliye, now let's look at the next question. According to the finance executives, what are the two common reasons for issuing warrants and convertible debentures? Actually, now people had stopped worrying about equity a lot. They were bored with the debt as well. People wanted both of these blends, lowering market rates and increasing liquidity, lowering finance cost and issuing equity shares at a future higher price, increasing the market volatility and in attracting new investors or maximizing short-term profits and reducing long-term liabilities. In this case, the correct answer is actually lowering the finance cost. People wanted to have lesser finance costs so that it hurts a little less. And issuing equity shares at a future higher price because the equity could be at least controlled a bit. I won't say it would be something we'll issue a lot because issuing a lot of equity is a problem. It's a big problem as such because you lose the voting power a lot. That's one of the truths. Done. Chal. Next point. Why are convertible debentures and debentures with warrants frequently used nowadays? Convertible debentures are used so that people are not worried about their money, whether it will come back or not. They increase market volatility, they improve cash flow, uh, matching and providing synergy and elevate agency difficulties. They decrease liquidity or they offer high returns with low risk. Why are convertible debentures and debentures with warrants frequently used nowadays? I think convertible debentures are a cool place because if you cannot pay, you can take care of it. You know? And warrants are basically if I don't have the debenture today, maybe I'll have a debenture tomorrow. Warrants are basically what? You are saying that if I won't be able to pay you now, don't worry. I'll provide you the equity shares. So you have a collateral. They improve the cash flow, manage matching, and provide financial synergy. 1 plus 1 is equal to 3 happens in this case because you are giving them assurance without actually giving them a security. And this alleviate agency difficulties. Agency means but the equity shareholders now sometimes don't trust the company and company doesn't trust the equity shareholders. Both of these people have a problem because in company by that I mean management. Management and equity shareholders are totally two different corners. So then sometimes equity shareholders feel that the management is not listening and management feels equity shareholders not listening. That's really pinches the people there. That is the specific area where they have to intervene and this particular thing really balances out, right? Because equity shareholders money is safe and at the same time the loans that we're taking is also taken care of. And I'm with you with the area of ABFM, Advanced Business and Financial Management. Acha everyone, what are we dealing with today? Today we are going to talk about the specific area altogether. I'll be talking about startup finance today. And then with hybrid, we have done a lot of hybrid based questions. Now let's talk about the next part. Chaliye. Let's talk about this. Let's talk about startup finance. Acha, what do you mean by startups, everyone? What do you mean by the term startup? Startups basically are the organizations which are absolutely new, right? They have been formed from scratch and it's been around, I would say, 5 years, but less than 10 years. Earlier, the definition had 5 and now it has been 10 years. Okay? That is how we define the term finance. Startup finance can be further stated like this. What defines a startup according to Wikipedia? Wikipedia has defined it as a company with minimal expense and high income. No, that cannot be the point. You know? Then comes the next point, that is a business intended to grow large beyond the solo founder. You know? Then comes a self-employed individual seeking entrepreneurship opportunities, or a registered business that never intends to grow large. Startup can never be an organization which is not looking forward towards growth. One of the basic things that they are look forward to is this: a business intended to grow large beyond the solo founder. They don't want to be a sole organization. That is a sole proprietorship. They want to go bigger. They want to go higher. Right? Chaliye. Now that's one more area that we have talked about. Let's talk about the next question. What is the purpose of Startup India Action Plan? India had decided to go for the Startup India Action Plan for a reason. That India required startups to come up. For years, there was a problem that India had a stagnation. Stagnation because the stagnation was because India was not even developing at all. For the growth, they needed people coming from India and telling that I would like to open my own business. I would like to explore the specific area. So it was done to discourage entrepreneurship and startup growth. No, discouraging can never be done. Na? You have to encourage, to create a policy framework for innovation in startups, to limit financial assistance and incentive for startups, or to increase bureaucratic hurdles for startup recognition. What's going to be the answer? Everyone? Chaliye, let's look at the answer. To create a policy framework to limit financial, you cannot limit, and you don't want to increase the bureaucratic hurdles as well. This will really deflect our country from the growth of GDP and further development. So I think I'll go for B. That is to create a policy framework for innovation. Innovation was the key of startups. The startups were introduced for this particular reason only, that they had something that was innovation. The primitive businesses were totally just based upon what is happening around. They wanted to grow further. They wanted to go beyond. है ना? Now comes the next point. Which category of actions does the Startup India Action Plan include? Financial penalties and restrictions, industrial government conflict resolution, financial assistance and incentives, industry, academia, collaboration, and simplification and coercion, tax hikes, and regulatory barriers. Okay, all of these are definitely some challenging negative terms. So what do you think? What category of actions does Startup India Action Plan includes? Okay. Financial penalties and restrictions, if you build them up, then people who wants to innovate, will they be able to establish their business? I think with a lot of restrictions, I'll be worried whether I'm following the rules or not. है ना? That's one particular thing I'll definitely think of. So, industry, government, conflict resolution. That's one part that is required. But is it the main point? Startup India action plan. Tax hikes are there, then these people will not have it. Most of the startups have tax planning campaigns. Matlab, you start your business and you get tax holiday for a certain period of time. You don't even have to pay a single penny, isn't it? So in this case, what would you say? I think I'll go for the answer C. This belongs to the area of financial assistance. They provide loans to these people. They provide incentives. They provide subsidies. Industry, academia, collaboration. Matlab, if I'm from the academic background and I found something really cool for my business, that is there. And then is simplification and coercion. What is the simplification and coercion? Simplification is based upon simplicity and coercion is basically stressing people. है ना? Done everyone? So in this case, the answer is C. It's an interesting question for sure. Everyone, if you haven't subscribed to our channel, then hurry up before your registration begins. Please subscribe to our channel, get done with all our courses so that you are able to grow further with us. Done everyone? Chaliye, let's talk about the next question. Acha. What benefits are startups eligible for under the startup plan? Benefits, startups, okay. What are the benefits that they're getting? Tax incentives only? Yeah, they get tax holidays. Government funding support only? They get both, I believe. You know, tax incentives, government funding support, capital gain exemptions, priority treatment in public procurement, or tax incentive and capital gain tax exemption only. Tax incentive means, that means if they're doing something, then you help them further. And exemption means that you see them earning, but you don't put them under tax in this. So in this case, the answer is actually C. Eligible startups, they get all these benefits. They get incentives from on the basis of taxation, and then they also get government funding. Government also provides them a lot of aids. Then government capital gain tax exemptions are there, and they get the priority treatment as well because they're just absolutely new. They're newbies in the market. These rookies gets a lot of importance because they are bringing something drastic changing in the market, so they are always valued a lot. Done. Acha, what is the purpose of Atal Pension Yojana? Atal Pension Yojana is different. It is a part of taxation there. The Atal Innovation Mission under the startup plan to provide financial support, to offer mentoring and advisory support, to act as a platform for promoting startup companies and innovation, or to facilitate patents and trademark applications. Everyone, what's going to be the answer? What is the purpose of Atal Innovation Mission? Atal Innovation Mission can be stated as to act as a platform for promoting startup companies and innovation. It's for both. According to the initial definition of Startup India, which is of the following statement is true? In actual, the definition was changed after a certain period of time. So they're asking about the initial definition. The entity must have a turnover exceeding 25 crores. The entity must have working towards innovation, development, deployment, or commercialization of new products, processes, and services. The entity can be considered a startup even if formed by splitting up or reconstruction of an existing business, or the entity must be incorporated as a private limited company, private partnership firm, or a limited liability partnership in India. Basically, the answer is A. नहीं अच्छा, there's some issue with the question. Huh? The initial definition had that this was up to 5 years, and yes, this was also part of it. The entity can be considered by splitting up. No, this was not in the first as well. The entity must be working exceeding 25 crores is also not there. The entity must be working towards innovation, development, deployment, and technology and intellectual property. I think I'll go for B. The answer is actually B. And the definition actually had this part as well, up to the 5 years from the date of registration. That they had earlier 5 years, this was exceeded by 10 years in the next definition. Actually, this is also the next similar question. यहाँ पर the main definition, what is the key requirement? Acha, in the initial definition, the main point was this only. Yeah? Acha, then I think based upon this, the correct answer has to be, this is the one I told. B is the answer. Here also, C would be the same point. 10-year time was defined under new definition. Old definition didn't give any of these things. Okay? If the working towards the innovation, deployment, development, or commercialization of new products, processes, or services driven by technology or intellectual property. According to the state startup policy, what is the purpose of having a startup policy for a state? To discourage the startups from operating in the state. Actually, opening up a startup policy, startup in our state is definitely more helpful. That is what I know. है ना? Then comes to provide funding, mentorship, and market access support for startups, to limit the number of startups in the state, or to impose strict regulations on the startups. What's going to be the answer? The correct answer is to provide funding, to provide mentorship, to provide market access support for the startups. Done? What is the purpose of pitch presentation of startups? Acha, everyone who came to when you asked me that, Niharika ma'am, I would like to put money into your business. Tell me about your business a bit. And if I cannot give you a proper definition to my business, or I cannot show you what exactly it looks like and what is my vision towards it, will you be able to put money into my business? We'll be looking at it like, why? Why not giving proper the information there? That means to showcase the entrepreneur skills, to provide an overview startup challenge, or to list the failures of startups. Pitch presentation is similar to that point now. If you asked me about my business and I see, if I talk about the question, if I would have just talked about the question and I'm not giving you details about the question, you'll be stuck with that. Arey, how do we look forward towards this question? Huh? I have to give the details of the question to you. Hai na? Only then it makes sense. So either to showcase the entrepreneur skills, Or next point is to provide an overview of the startup challenges, to list the failures, or to showcase business and convince investors to invest. If you have to go for the answer there, the answer has to be to showcase the business and convince investors to invest. That is what we look forward to, everyone. Okay? Because we have to tell people that our business is worth giving money. We're gonna say this to them. But then they will always want ki show me something, na? Give me the potential that you have. Show us that specific area. Only then we can give money to you. Otherwise, we will not give. Right? Next point. What is the purpose of pitch deck? Then to provide funding for the startups, to assist the building of pitch presentations for startups, to offer mentorship for entrepreneurs, or to promote startup competitions. What is that specific area regarding pitch deck, everyone? What's going to be the answer? The purpose of pitch deck is this: to assist the building pitch presentation for startups. Matlab, we'll be helping the new startups to make their own presentation more clear. ठीक है? चलिए, done. What is the focus of Incubator Grand Challenge introduced by Atal Innovation Mission? Recognizing successful startups, providing financial support to established incubators, supporting international startups, or promoting academic research. What's going to be the answer, everyone? Incubator is basically a situation where the kids are kept, the newborn babies are kept in the incubators to provide them a similar atmosphere as they had in their mother's womb, and so that their lungs are ready for proper breathing, as well as their body heat can be maintained. So when we talk about the startups are just like newborn babies. Na? These babies wants to grow, but how would they grow? We have to recognize successful startups, providing financial support to established incubators, supporting international startups, or promoting academic research. The answer is providing financial support to the established incubators. They are providing the financial supports. ठीक है ना? This helps because one of the basic things that is required in the beginning is funding. That funding plays a very, very important role.
We have time. Earlier, our examination was supposed to start in. See, our examination normally starts in the. It started a little earlier last year. Though, if I talk about the reality, things are changing a lot since the syllabus changed this year. We have the problem related to the area of elections being clashed in the JIB area. So there were changes in the JIB examination recently as well, but our examination is way after. So I think we are good to go. Our examinations will start in July, and then we have June, July area for our exam. And everyone. Acha, with this, I am done with all these things individually already. I hope you remember that part. We are done with all these classes individually. Individual chapters are all sorted, but now I'll be talking about the blend of multiple chapters. So this is basically a blend of multiple chapters that we are taking up. I have also discussed many of the chapters as well, individually, as well as mixed chapters, entire modules as well. So let's look at it, everyone. How do we pursue further? We are looking at the victory series. In the victory series, what's the first thing? Acha, this is related to the area of tax-free reorganizations. Acha, what does the step transaction theory aim to prevent a tax-free reorganization? It aims to prevent acquirers from assuming the liability for target company debts. It aims to prevent the target shareholders from receiving excessive compensation. It aims to prevent transactions that resembles sales from quality as the tax-free reorganizations, or it aims to prevent target companies from retaining the control over the business operations. Its basic work is basically to prevent the transactions that resembles the sales from qualifying as tax-free organizations. See, sometimes you are making sales and you are making good money. But what if this money is taxable and you are putting into reorganizations? So they make sure that this doesn't happen. Na? Done, everyone? Chale. The answer is C. They try to prevent the transactions which are actually not taxable. They want that only the not taxable areas should be removed. The ones which are taxable should not be included. Done? Chale. Moving on to the next point. In US, what is the period for net operating losses that can be carried forward or backward? Is it 10 years and 10 years forward, 5 years backward, 20 years forward, 2 years backward? And then we have there are 15 years forward, 3 years backward, or forward for 5 years and backward for 10 years. What's going to be the answer, everyone? In terms of US, you can extend it up to maximum 20 years forward and 2 years backward. In our country, we cannot have backward losses in terms of this. They can be carried forward for maximum 8 years. But the depreciation can be continued. है ना? चलिए. What conditions must be satisfied for the capital gains arising from the transfer of the assets to be exempt from tax and amalgamation? The amalgamated company must be a foreign company. The scheme of amalgamation must satisfy the section 47.5. The scheme of amalgamation must satisfy the section 2 subsection 1 subsection B, and the scheme of amalgamation must be approved by RBI. If you really want exemptions, there's only one point. That was 2 subsection 1B. Done, everyone? Chaliye. What is the significance of amalgamated company? What do you mean by amalgamation, everyone? Normally 1 plus 1 is equal to 2. Hai na? Normally we say that 1 plus 1 is equal to 2. What if in an organization, if one has positives, second one has positives, and this becomes more than 2? Because both of their positivities are to be added there. Then it becomes more than that. What is the significance of the amalgamated company being a company for tax relief purposes? है ना? So what do we do in this case, everyone? What's going to be the answer? It ensures the it ensures the compliance with foreign tax laws. It facilitates the transfer of assets across the borders. It allows easier regulatory approval, or it is requirement of the exemption from capital gains tax. Amalgamated company and Indian company. See, in case of amalgamation, when two companies amalgamate, it is covered under Section 47. If one company has shares and it gives shares to other company, then this is movement of shares. Nobody is getting money and nobody is spending money. If nobody is getting money, nobody is spending money. Then I think in this case, there's one particular thing which is absolutely clear. There is no tax. It is requirement for the exemption from capital gains. Chaliye, let's look at the next question. In case of transfer of shares, everyone, we're talking about the transfer of shares. When a transfer of shares by shareholder of an amalgamated company not regarded as a transfer of for capital gain purposes. When the transfer is made in consideration of cash payment, when the transfer is made in consideration for allotment shares in the amalgamated company, when the amalgamated company is a foreign company, or when the transfer is made without any consideration. What's going to be the answer? Amalgamated company not regarded as a transfer under capital gain. When the transfer is made, if you have cash payment, it becomes taxable. It is an amalgamation is covered here, which this means that the companies are merging together, but there's one particular thing which is clear. That with this clarity, the amalgamation involves a payment of cash, which is taxable there. So the first point is definitely true. When the transfer of is made under consideration of allotment in amalgamated company, when the amalgamation is with the foreign company, it is considered here. When the transfer is not made without any consideration, I think if we talk about shares now, if you have shares, you give shares. When the movement is totally on the basis of shares, it's based upon only one thing. When the transfer is made in terms of allotment, shares versus shares, there's no movement. है ना? चलिए. Done, everyone? Under Section 47, subsection 7 of Income Tax Act, what are the capital gains arising from the transfer of the shares by shareholders of amalgamated company exempt from tax? When the transfer is made in consideration of the cash payment, when the transfer is made in consideration of allotment of shares of the amalgamated company, when the amalgamated company is a foreign company, or when the transfer is made without any consideration. What's going to be the answer? Even though it's a transaction but not stated as a taxable one. When will this happen, everyone? What's going to be the answer? In this case, what's going to be the answer?
The answer is when the transfer is made in consideration of allotment of shares in the amalgamated company. See, amalgamating and amalgamated, the company which is converted into some other company is to be considered here. A new company is being bought. So when one company is converted into another company, that is to be considered in this case. An old company is now a new company altogether. So when we are trying to have this kind of situation, this is where the organization is looking at what? They're trying to expand. When you're looking forward towards expansion, you are amalgamating with another company. You want the growth, so by looking forward towards the growth, you are amalgamating companies. The companies which will become one later on. And the company that is being formed is called amalgamated company. That is the difference between these areas. We have amalgamating and amalgamated. This is what is trying the process, and this is the ultimate reach. The rule says in terms of direct tax, and this one particular beautiful point. That is, if you enjoy the money, you pay tax. If you don't enjoy the money, why to charge money from you? That is to be covered in this area. Okay? Done? Chali. Now let's look at the next point. What conditions must be fulfilled for a company to take advantage of the carry forward of accumulated losses and unabsorbed depreciation under Section 72A of the Income Tax Act, everyone? But there are certain rules. If one company is facing losses, it can continue. It can try to make the losses a little better. The losses can be recovered. We have to make sure that we are recovering the losses altogether. And how do we recover the losses? If it belonged to the previous organization, they will continue with the new organization. This will ensure that the new organization is also getting money. It is also getting the benefit of all the losses which the previous organization genuinely faced. So in this case, there's one particular thing which they clearly say, that when we're talking about the organizations altogether, then every organization is looking forward towards growth. And that is why if they have to amalgamate or join hands with other organizations, they will do it duly. So in this case, when they do this part, then the amalgamated company should be a foreign company. It should be engaged in the business. It should be an Indian company, or it should not be a public sector company. It has to be only one thing, an Indian company. A past Indian company can give its losses and depreciation to the new Indian company. This is allowed. If the past Indian company is not there, then new Indian company cannot get the funds. So we need to have two Indian companies which are amalgamating. Okay, na? That is something we cover. How long must the amalgamated company hold at least 3/4 of the book value of the fixed assets? 3 years, 4 years, 5 years, or 6 years? If you are an older company, now it becomes a new company. New company has to hold all the assets and liabilities of the previous company for a certain period of time, that to 75%, also called 3/4. In the law, it is written 75% of the previous company's assets and liabilities has to be taken over by the new company. And not only they have to take over, but they also have to keep it in their hands. Okay? Done, everyone? The answer is 5 years.
Let's look at the next question. What is the consequence if the specified conditions of for amalgamation are not fulfilled? Amalgamation is cancelled. Amalgamated company receives tax benefits. Business loss and unabsorbed depreciation are treated as income, or amalgamated company receives government funding. The consequence of specified conditions for amalgamation are not fulfilled. When the amalgamation is not fulfilled, there's only one problem, that is business loss and unabsorbed depreciation are treated as income. These things which could have been carried forward, which the company could claim कि the previous company faced losses and the present can also utilize it to set off. This utilization will not be allowed. That's the worst part, that even if it was justified, even if this was the reason that you amalgamated two companies because one of them was excessive losses, so that's to be covered. Done. चलिए. चलिए. What is the rate at which income tax is levied under MAT if the amount of income tax payable under the general provisions of ITA is less than 15% of book profits? It is 10% or 10%, 15%, then is 20%, or the last is 25%. In this case, the answer is 15%. Chaliye, then this is it for the day, everyone. I hope this session was helpful for you. If it was, then please let me know. Chaliye. And here comes our website, everyone. If you're looking forward towards our courses, then what you need to do is check out our website. That is www.adda247.com. Just need Adda247 to go to. You just went on to Adda247. Then once you go to the area of www.adda247.com, go on to the area of JIB and CAIIB.